Imagine you and 9 friends each invest $1,000 to start a bakery. A year later, your bakery makes $10,000 in profit. How much is your share? Simple math, right? $1,000. Now what if your bakery makes $50,000? Your share jumps to $5,000. That's earnings per share in its purest form, and it's one of the most powerful numbers in the stock market. Welcome to Money and Market, where we make investing simple. Today we're diving into earnings per share, EPS. When you own stock in a company, you're not just buying a piece of paper. You're buying a slice of that company's profits. EPS shows exactly how much profit belongs to each share you own. Think of it like this. You and your friends own a pizza shop together. At the end of the year, the shop makes $60,000 in profit. If there are 10 owners, each person gets $6,000. But if 20 people own the shop, each person only gets $3,000. Same profit, different slice size. That's EPS. The formula is beautifully simple. Take the company's net income. That's the total profit after paying all expenses, taxes, and everything else. Then subtract preferred dividends. Now, you might be wondering, what the heck are preferred dividends? Here's the deal. Most stocks you see are common stock. That's what regular investors like you and me buy. But some companies also issue preferred stock. It's like a VIP ticket. Preferred shareholders get paid first. They usually get a fixed dividend every quarter, but they don't get voting rights. So when we calculate EPS, we subtract those preferred dividends first, because that money isn't available to us, the common shareholders. Whatever's left gets divided by the number of common shares outstanding. That's it. Net income minus preferred dividends, divided by shares outstanding.
Now here's where it gets real. Let me show you 2 companies and you tell me which one is actually making more money per share. Company A has $5 million in net income, $200,000 in preferred dividends, and 1 million shares. Company B has $8 million in net income, $300,000 in preferred dividends, and 2 million shares. Take a second. Which one has higher EPS? Company A's EPS is 5 million minus 200,000, that's 4.8 million, divided by 1 million shares. That gives us $4.80 per share. Company B is 8 million minus 300,000, that's 7.7 million, divided by 2 million shares. That's $3.85 per share. Company A wins. Even though Company B has higher overall profit, Company A generates more earnings per share. This is why EPS matters. It levels the playing field. You can compare a tiny startup with 1,000 shares to Apple with 16 billion shares. But hold on. Before you rush out and buy every high-EPS stock you can find, we need to talk about the full picture. Let me tell you about Nike. In 2024, Nike bought back over $5 billion worth of its own stock. Why would a company do that? Here's what happens. When Nike buys back shares, those shares disappear from the market. Let's say Nike has 1 billion shares outstanding and makes $4 billion in profit. That's $4 EPS. Now Nike buys back 100 million shares. Suddenly there are only 900 million shares left. Same 4 billion in profit, but now divided by fewer shares. EPS jumps to $4.44. The company didn't make more money. They just sliced the pizza into fewer pieces. In October 2024, as Nike's stock was plunging, dropping 25% for the year, the company ramped up buybacks. They bought 6 million shares in July alone at an average price of $74. Some investors loved it. Fewer shares means higher EPS. Other investors weren't so sure. Was Nike buying shares when they were actually expensive, just to make the numbers look good? Here's a real insight. Companies often buy back shares when times are good and stock prices are high. That's exactly when they shouldn't be buying. The best time to buy back shares is when your stock is in the gutter, when it's cheap. But that's also when companies are usually struggling and don't have spare cash. It's a fascinating paradox. So what actually makes EPS move? 2 main things. Profit and share count. If a company boosts its net income, maybe sales go up, costs go down, operations get more efficient, EPS climbs. If net income drops, EPS falls. Pretty straightforward. But the share count is where things get interesting. Remember our birthday cake analogy? Imagine you're celebrating your birthday and more people keep showing up throughout the night. When it's time to serve cake, you have to cut it into more and more pieces. Each slice gets smaller. That's share dilution. When companies issue new shares to raise money quickly, maybe to pay off debt, fund an acquisition, or invest in growth, the existing shareholders get a smaller slice of the profit. Their EPS goes down even if the company is making the same amount of money. But the opposite also happens. When a company buys back shares, it's like fewer people showing up for cake. The remaining guests get bigger slices. This is why share buybacks boost EPS. And some companies love this trick because a rising EPS makes investors happy, which pushes the stock price up. Let's talk about something crucial. EPS can be negative. Startups and fast-growing companies often report negative EPS because they're pouring money into research, expansion, marketing, everything that will hopefully pay off later. Amazon had negative or tiny EPS for years while building its empire. A negative EPS isn't always a red flag. What matters is why it's negative. Is the company investing in growth, or is it just losing money with no plan? You'll also see EPS mentioned everywhere with another metric, the PE ratio, or price-to-earnings ratio. The PE ratio takes the stock's current price and divides it by its EPS. Let's say a stock trades at $100 and has an EPS of $5. The PE ratio is 20. That means investors are paying $20 for every $1 of earnings. If the PE is really high, like 50 or 60, investors are betting the company will grow like crazy in the future. If the PE is low, like 8 or 10, maybe the company is undervalued, or maybe investors think growth will be slow. EPS is the foundation of this whole calculation. Now let's get into the pros and cons. EPS is simple, clear, and easy to compare across companies in the same industry. It tells you how profitable a business is on a per-share basis. But it has blind spots. EPS doesn't show debt. A company could have sky-high EPS but also be drowning in debt. EPS doesn't predict the future. A company with great EPS today might face huge challenges tomorrow. And here's the big one. EPS can be manipulated. Companies can use accounting tricks, aggressive buybacks, or one-time adjustments to make EPS look better. Always look at the full financial picture. Check revenue growth. Is the top line actually growing or just staying flat? Look at cash flow. Is the company generating real cash or just paper profits? Check the balance sheet. How much debt is the company carrying? And look at EPS trends over several years, not just one quarter. Here's a real example. For the fourth quarter of 2025, 75% of S&P 500 companies reported EPS above analyst estimates. But the market's reaction was muted. Companies that beat expectations saw their stock rise only 0.3% on average. Why? Because investors are getting smarter. They're looking beyond the headline number. They want to see real growth, sustainable margins, and smart capital allocation. A company that boosts EPS through buybacks while revenue is shrinking? Investors see through that now. So what should you do with EPS? Use it as a starting point, not the finish line. When you're researching a stock, check the EPS first. Is it growing steadily year after year? That's a good sign. Is it jumping around wildly? That's a red flag. Then dig deeper. Look at why EPS is moving. Is it because the company is selling more products and earning higher profits, or is it just financial engineering? Compare EPS to competitors in the same industry. Here's your takeaway. Earnings per share is one of the most important metrics in investing. It shows you how much profit each share of stock earns. It helps you compare companies, spot trends, and make smarter decisions. But never use it alone. Combine it with revenue, cash flow, debt levels, and industry trends. The best investors don't just look at the numbers. They understand the story behind the numbers. That's how you find real value. That's how you avoid expensive mistakes. And that's how you build wealth over time in the stock market. Thanks for watching Money and Market. If this helped you understand EPS, Hit that like button and subscribe for more investing breakdowns that actually make sense. See you in the next one.